Hello, welcome back. There has been a massive trend for EVs this year, electric vehicles that is. With a recent uptrend of Tesla and NIO as well, there have been some other companies too, like Lucid Group, which is a seller of electric vehicles and has been performing insanely well as well. And you can see here in the performance returns that in the past year, the company has gained almost 220%, which is outstanding. And so far this year, it has earned 18%, which is what a lot of companies wouldn't even make in 1 year. And so this is amazing for the stock and the company, but it potentially gives investors an entry point. The thing is, we want to examine whether it's actually worth it to enter here, or we should wait or just avoid buying Lucid altogether. And the thing is, the high was at 53, right now it's at 40, 44, almost 45. And so there is a little bit of a leeway till it reaches its all-time high again. Actually, it wasn't even all-time highs. All-time highs were here. But we do want to examine the financials of the company, see whether it actually makes sense from an investing perspective, an investor, to actually enter the stock. And so what we're going to do is slowly examine the financials and see whether it actually makes sense for us to enter this market with this company as well. So the outstanding shares is the first thing that we take a look at, and we'll see that there's a little bit of extra over here. However, it's a very small amount, so I'm not necessarily too cautious about that. A little bit of an increase, but not insane increase that would dilute investors too much. So I'm okay with that. And next up, I'm taking a look at the income statement just to see what the company has been making. And obviously that's a very new company, so we don't have too much data. But we do have a couple of years or so in the last 12 months too, about 3 years in total. So we can take a little bit of a look at what's going on here. And you will see and you will notice that there has been some year-over-year growth over here. There are some entries, some null values here that are not calculated. But you will see that overall the company seems to have lost money over the years. Since 2019, then 20, and then to current last 12 months, lost even more actually. And you could expect that from a company that's growing and growing rapidly, hopefully. But you have to always know that if you were to enter at this kind of company, you are basically entering at a moment in time where the company is not even making any money, and the valuation is $74 billion of a market cap. So that sounds a little bit, or way too much, overvalued really. And so let's continue and take a little bit of a closer look at the balance sheet. The balance sheet seems to be increasing in terms of the total assets here and the total equity, which is at the end the most important thing really. But you will notice that the reason why it increased was the additional paid-in capital, which is basically shares. So basically the company sold stock and got money from investors. It hasn't been increasing because the company made money. So that's not the reason. And that's not super healthy. That's not healthy at all really. It's okay for the first few years of the company though, so this is a new IPO relatively, so it's okay, but I still want to see growth in terms of the operations of the company, and we can take a look at the cash from operation, operating cash here, and see that the company is actually losing money year over year, and actually losing even more every year. So this is very, very concerning, and it's something that I wouldn't want to see for sure. And there's a little bit of investing here, yes. And financing, a lot of financing, as you would expect, because the company needs money, starving for money, it looks like. So I would think that's a very, very high probability that the company would eventually issue more shares and dilute investors even more, especially now that the current valuation is pretty high. So I would definitely expect the company to potentially add more in its outstanding shares, add more shares, and sell more shares to other investors, or the same ones, and basically dilute the current ones. It's something that will potentially happen, maybe not necessarily next year because they do have a little bit of money pocketed right now, but I think over the long run, in 2 or 3 years even, there's a high probability that they will actually issue more shares. I'm pretty sure about that. And free cash flow also in the negative, so the company is losing money hand over fist here, and I'm not seeing much of a sign that this is going to revert anytime soon really. It may, but right now the company is not making anything really. And the solvency ratings over here, yeah, just because the company got a lot of extra funding from investors, there's really basically not much debt when you compare it to equity, because the company actually doesn't have debt. The company has sold equity so far. At some point, this value will increase, I'm pretty sure, because the company will have to buy to get some debt at some point rather than issuing shares. But I think for a little while they will still keep issuing equity to fund themselves, and then eventually switch it and gain some debt, since their total debt to equity is actually pretty low right now, and so they don't have much debt. Now, what am I doing with this kind of token, this kind of company, really? The thing is, I'm not a big fan of companies that don't make money, not a fan at all, really, unless they are growing really, really well and really fast. The problem that I'm seeing here is that I'm not really seeing a growing company when we're talking about the income of the operating income that the company makes, for instance. And the year-over-year growth is very little. I mean, it's okay for a company like this, of course, but um, in order to um, in order to somehow make up for this market cap, you would need to have some growth that would be in the hundreds. And right now, this doesn't seem to fit the story. And also, the company is actually losing money, even though it's growing, which can also happen. Okay. The thing is, for me, I think this is a very, very risky play, just because I expect that the company will keep getting debt and keep issuing shares and diluting me if I buy here. So I just cannot see myself entering this kind of market right here at this price. Maybe I would want to enter if the stock was much lower, much lower. Though it would probably have to be around 10 or so for me to think about entering. But right now I just don't see it. At least for me, uh, yes, there's a lot of return, but that's probably on the stock price. That's not the company, and that's definitely because of the trend, the trendiness, how trendy EVs are, and it's basically a sympathy play, as I mentioned in a previous video. It's moving along with Tesla and NIO pretty much. And if I were to pick one of those three, Tesla, NIO, and Lucid, personally, I would pick NIO. And maybe I will make a video about it actually, and just a little bit compare the three. I, I, I wouldn't buy either of them if I were to pick among other stocks. But if I had to pick one of the three, it would probably be NIO at this present time, at the current price. All right. So yeah, that's what I wanted to say about Lucid. And let me know what you think. Do you own it? Do you think it's gonna outgrow my concerns and grow massively in the future? Who knows? Let me know what you think. And if you did enjoy the video, take a look at this one that I created about Alibaba and why it's going higher and higher. And I'll see you in the next video. Bye bye.